So good afternoon and good morning to everyone. I guess sorry for this mishap. I hope you can all hear me fine. Some echo in the room. Okay, this should be better. Welcome to everyone. We're just about to start that meeting, and I hope that webinar. Welcome to everyone. People are joining this webinar today. Thank you for your attendance, and I will greet also our speakers who will be here. This event is part of a series called the Business Leaders Forum, and this is the first event of this year. It's called the Financial Forecast Webinar, and we'll be trying to give you an overview of some of the major trends that we see in the macroeconomic and financial world, both in Japan, in Europe, and I guess worldwide. I just want to take a few minutes to introduce myself. My name is Vincent Chanron. I work for the French Chamber of Commerce in charge of this program, Business Leaders Forum. And I'll just take a few minutes to introduce this agenda. We will have an introduction by Armel Cahierre, the president of the French Chamber of Commerce. And then we will hand it over to our distinguished speakers. Today we have three speakers, Mr. Ryutaro, who is Chief Economist at BNP Paribas Japan, Ms. Alicia Garcia Herrero, who is Chief Economist for Asia Pacific and Natixis, and finally Mr. Juckes, who is Global Head of FX Strategy at Société Générale. As always, after their presentation, we will have some time for questions and answers to discuss some of the new trends that we see in finance, but also we'll welcome your questions that you might have from the audience. And for that, I'm sure you are all quite familiar with this nowadays. You can use the Q&A button at the bottom in order to ask your questions, and we'll make sure to ask them to our panelists. And without further ado, I give the floor to Mr. Armel Cahierre, who will then make an introduction. Armel.
Thank you. Welcome to all of you to this event on financial forecast. As mentioned by Vincent, it's the first event of the year of the Business Leaders Forum series. This series of events will be finishing with an event in November, which will be called, which will have for theme the vision for 2050. I think it is, we have this, of course, economic discussion every year. But I think it's very interesting this year because we come out of a very, very specific year where very few movements of goods and people, where governments have been spending a lot of money to face the pandemic, thus raising the debt of most of the countries. We see words of inflation here and there. And it's quite interesting to have the views of these top economists on how the world is going to recover this in the next few years, but also what do they think, what kind of a world we'll be leaving for, I'd say, our children or grandchildren, or people who are going to be in 2050, and what kind of debt burden they will be left with, what kind of lessons they can learn from this, and all of the topics that they might find interesting to point out. So I will not speak too long. Thank you to all to join this, and I leave the floor to the speakers now. Thank you very much.
Thank you, Mr. Cahierre. And without further ado, I think I've already introduced our guest speakers for today. So I will leave the floor to you, Mr. Ryutaro, and you've chosen to entitle your speech "Causes of Secular Stagnation in Japan and Countermeasures," but we will hear what you have to say about this. Mr. Kono, up to you.
Yep. Thank you. Yeah. Hello, everyone. My name is Ryutaro Kono, Chief Economist of BNP Paribas. Thank you for giving me the opportunity to speak in front of you. I will talk about the cause of secular stagnation in Japan and how to deal with it. For the past 25 years, I believe Japanese economy has fallen into a bad equilibrium characterized by low growth, low inflation, zero interest rate, and expanding public debt. This is so-called Japanification that did not change under the current pandemic. Rather, the bad equilibrium may have been strengthened. So, what is causing the slump in the Japanese economy? My hypothesis is that even in the economic recovery phase, Japanese companies are only accumulating profit and curbing spending, which is the cause of low growth. As the graph on page 1 shows, Japan IT investment. Can you see my chart?
Yes, your chart is active with the IT-related investment spending.
Yes. Yep. Chart. Yep. Other graph on page 1 shows Japan IT investment and real wages remain sluggish for this 3 decades. And even after non-performing loan problem was resolved in the mid-2000s, Japanese companies continue to curb spending and save money. The graph on page 2 shows that the corporate sector has been in excess of saving since the mid-1990s. Companies continue to save because of the repeated major economic crises, such as the financial crisis in late 1990s, dot-com bubble burst in early 2000, the global financial crisis in late 2000, and the Great East Japan earthquake in early 2010s. Under such crisis, cash-rich companies that keep spending low have survived. Even in this pandemic crisis, Japanese companies believe that they have been able to avoid bankruptcy and job cut thanks to curbing spending. So, as CEOs regard it as a successful experience, they will continue to save without increasing spending in the next economic recovery phase. From the viewpoint of macroeconomy, as companies increase their saving, the balance between saving and investment would be lost as a whole, and the natural rate of interest and potential growth rate remain sluggish. So monetary policy remain ineffective and cannot foster inflation due to the slump in natural rate of interest. To avoid recession, government would absorb excess corporate saving by repeating additional fiscal policies. However, the expansion of public debt distort resources allocation and lead to further stagnation of natural rate of interest and potential growth rate. And so, when public debt rise, people are concerned that social security system cannot be maintained, and so curbing consumption and increasing saving with precautionary motives. Why Japan's companies did not increasing their spending and just saving money? It is probably because their growth expectation remains sluggish And its main reason is that personal consumption continues to be sluggish. And sluggish private consumption is partially due to the aging population, but more so, perhaps because companies are curbing wages, even in the full employment. In order to cut labor cost, companies are increasing non-regular employment with poor human capital. Non-regular workers are afraid of being fired in a recession. And even if their wage increased during a boom, they will save money without increasing consumption. It seems that the risk-sharing function of society have been lost, and that there is a fallacy of composition in which both companies and households save money without precautionary motives. As the chart on page 3 shows, companies have recently curtailed OJT and OJT on the job training and off-the-job training in order to cut costs, even for regular workers. As a result, human capital of regular workers doesn't improve. And it is not possible for corporate sector to provide new goods and new services that attract their customers. So business CEOs recognize that they are making profit not because of increased employee productivity, but because of cost cut. So a kind of vicious cycle of not raising wages continue. In the late 2010s, recovery in consumption was very anemic, despite the serious labor shortages, which is never seen since early 1990s. Unfortunately, there is no magic wand that will solve all problems if you do this. However, one of the reasons why Japanese households curb their consumption is that they doubt the sustainability of a social security system. This is because Japan's social security system is financed by the budget deficit, and it is necessary to secure the strong financial resources. Also, one of the anxiety of non-regular workers is that they do not have a safety net, such as medical insurance and pensions. Therefore, reform of social security system is an urgent issue, I think. In order to enhance social security system, we need a tax increase. However, it might be damaging to fragile economy. So, as Japan's potential growth rate is less than 0.5%, and the tax increase of 3% like in 2014 or 2% like in 2019 could be very damaging. What should we do? For example, with 0.5% tax increase once every 3 years, we might achieve both economic recovery and social security reform. Of course, with 0.5% tax increase once every 3 years, it would take 90 years to raise consumption tax rate to 25%, but it will not collapse even in the recession time, I think. What we need is to build a long-term fiscal reform plan. Of course, given the widening economic disparity worldwide, it would be necessary to consider raising corporate tax for corona crisis, even in Japan, I think. This is my keynote speech. Thank you.
Well, thank you, Mr. Kono, for this presentation and giving an honest view of the situation here in Japan. I think this is a great transition for our second speech, Ms. Herrero, who will speak also about the Japan economy, but also mostly about how it fits into the worldwide economy and especially the relationship with the EU. So, Ms. Herrero, I give the floor to you.
Thank you very much. First of all, I'd like to thank the French Chamber in Tokyo for this kind invitation. It's a pleasure to be with you all. I'm going to be brief for the sake of time because I need to cover the world, Japan, and EU-Japan relations in 10 minutes. But I'm going to try very hard to stick to the time. So perhaps just in a nutshell, the message I'm going to deliver here is that the global economy is in recovery, notwithstanding the fact that we're not yet out of the pandemic, simply out basically through huge stimuli, fiscal and monetary, especially in the US, but also in Europe to a lesser extent, but also quite importantly in Japan and in China. So that's why we're growing. And we shouldn't be denying either the growth or the reasons for the growth, meaning there's no new productivity that explains this growth. So it is temporary, and we can't forget that. So on that note, if you move ahead my slides, I think I can't do that myself. I just want to remind the audience that 2021 could be one of those years, we probably have not seen this in the last 4 decades, where the US could possibly grow more than China. So we have a rather modest growth forecast at Natixis. We are one of those banks which still hold a rather benign view on inflation. And one of the reasons is that we don't think the US economy is exploding. So it's a 6.9% huge base effect. But others have 8% growth. And that means, you know, the more you see that, the more you will end up with inflationary pressures. Next. Inflationary pressures in the US are important for financial variables, and I'm sure we'll hear more about that later, so I won't expand on that. But I just want to note that the recovery of the US economy has some cold feet, some muddy feet, because the labor market is not yet fully in place. And this is why the fiscal stimulus that the Biden administration has announced, and more probably to come on the infra, etc., basically is trying to solve this conundrum that there's a big part of the population yet not out of the woods. All of this means that in our view, no matter the very large inflation figure we saw, which basically astounded the markets last week, we still think that the Fed will not exit soon and that it will take some time to taper. And if needed, it will just intervene in the market to avoid a very rapid increase in US Treasury yields. Next. On that note, you see there the very humpy shape of inflation in the US in our view. So yes, very scary, but temporary. And that's a rather modest increase in US Treasury yields. Next. I move quickly to Europe. So Europe, I'm quite happy this seminar only took place on the 18th of May. Because had I been here 2 weeks ago, I would have been much more cautious about anything I had to say about Europe. Why? Because in the last 2 weeks, vaccination has accelerated to a point of really misbelief, you know, as a European. But it is true. Single individual countries of the size of France, Spain, Germany, Italy are vaccinating 600,000 persons a day. And that means that our targets for vaccination, which looked simply crazy only 3 weeks ago, will probably be achieved. This also means that Europe will achieve, by all means and purposes, herd immunity within the year, no doubt about it. Possibly, and this is quite something, at the same pace as the US and the UK. As simple as that. This is based on a continuous acceleration of vaccination. But I'm just saying, whether it's slightly earlier or slightly later, the point is we're all on the same boat in the developed world. It's going to be this year. And this is not true for the East. And I like to just say that that makes a difference in terms of the actual recovery or the doubts about the recovery. I think there should be no doubt, next, that Europe is going to grow at a pace of around 4 point. I mean, I'm not saying that number is going to be exactly the number, but rather certainly double its potential growth, at least, or even 3 times its potential growth this year. Of course, on the basis of a stimuli, no doubt about it, beyond the European Central Bank and the national fiscal stimuli, we have obviously the new generation plan, and that's big money for some countries. And I just want to remind the audience that these are huge opportunities for Japan-Europe relations because of what it means for some sectors, digitalization, green, and beyond. And you can see from that graph that it's not going to happen only in 2021, actually hardly in this year. It's going to be mostly in the next 4 years. And that means that growth will probably hover above potential in Europe for a few years. Next. So China, I mean, this is actually my expertise. So I'm basically covering Asian economies. And I just want to note, and we had data yesterday on retail sales and IP industrial production, that yes, the recovery looks robust, but it is not as healthy in terms of consumption as we all wish it would be. We're not yet back to levels pre-COVID. And this is true actually quite generally, you know, especially on the service sector globally. But China is a very, very strong example because of the lack, basically, of any measures of containment domestically. So it does look as if consumers are changing behavior. And this is quite important for companies, whether in Asia or even elsewhere in Europe or the West more generally. Next. So what this means in terms of financial variables, and I'm just rushing, is that we are seeing at Natixis a weaker dollar, and simply because the stimuli are humongous in 2021, which also means that the renminbi will probably hover around that depreciation of the dollar, meaning that we'll have some slight appreciation of the renminbi, but in line with other currencies. So nothing really spectacular, because the PBOC is going to avoid it. And there's many ways to do that without even intervening in the market. And we're seeing a little bit of that already. So for example, allowing more outflows for portfolio investment abroad. Next. Of course, the one on the other thing in the previous graph is just to remind everybody that anything I say will depend on a sudden change in U.S. Treasury yields. So we're assuming that they behave nicely. On China, the thing to watch is really financial risk. It's on the rise. It's not only private, it's also state-owned. It's not only non-financial state-owned companies, even on the financial side, as Huarong showed all of us very clearly, we could have a major systemic event. And that's something that I think is kind of not fully discounted in the market and could actually surprise us negatively for China's outlook this year and beyond. Next. So to conclude, I'm not going to talk about Japan because we already heard about Japan. I have the very same message. It's quite nice on the cyclical part of the story, but we're basically, unfortunately, not seeing the structural change needed for Japan to basically grow faster in the medium run. Next. So this is all the more the case given the very slow vaccination, both in Japan and in generally in Asia. China is speeding up as we speak, but there's also the issue of the efficacy of vaccines, which frankly we need to take into account next when assessing the situation. just a note on the BOJ. I mean, our call on the BOJ, notwithstanding the review of monetary policy, and what for many has meant that there could be new cuts. We're not of that view unless we really have a massive appreciation of the yen. We don't think that the BOJ likes the example of other European, let alone Swiss central banks, where you see the cost of going too much into negative territory. Next. So I'm going to end with a word on EU-Japan relations very, very briefly. I actually think that by focusing on trade, we're missing a little bit the picture and the boat. Why? Because we are two stagnating regions. And it may sound negative, but it is true. So because it's true, I think we should actually revert that into positive rather than deny what is true. And I say that very bluntly because I happen to hear that all the time. And it's not only about Japan, EU, but EU with other, developed economies, what to do. And finally, we're missing, the growth elsewhere. So this is what happens, that our trade compared to global trade is shrinking. And therefore, our economic relations, in a way, if you only measure trade, will shrink as a percentage of all other trade relations. Next. So the elephant in the room, on top of everything, is, of course, the growth of China for Japan in terms of Japan imports and exports. So that shrinks a little bit the importance of Europe, notwithstanding the economic partnership agreement that was signed in 2019, which kind of has stabilized a little bit our trade share, but that's all. It's not going to grow any further. Next. So same thing with Japan into Europe, the same reality is stagnation of the market share. Next. So what to do? So here is what I think we should be thinking. Maybe, I mean, I'm not saying nobody's thinking about this, obviously, but I'm just saying, whoever is thinking about it, please go ahead and think about it even more and put it forward, because there's so many other things we can do other than just trade. Trade is important, but there are many other things that can push the relation further. And this is, of course, climate change. This is global health issues. This is aging-related innovation, very important for both, and semiconductors, very important for both as well. So we're creating all of these industrial policy funds in Europe. And sometimes I wonder whether, we just published a note at Natixis called the Symphony of the Semiconductor Industry. The whole point was that a single country can't do it all. So, why not try, think imaginatively about our economic relations and move forward. Next and last, just some takeaways. So yes, we're in a recovery. That's great. We have a few waves here and there. I'm not saying it won't be important, especially for Asia because of the delay in vaccination, but we're back. But we're back temporarily, even in the US, even in Europe, even in Japan. So we need to think about productivity, innovation, new ideas. This is what is going to save the boat. We're not going to become the largest economies in the world anymore, nor maybe do I want to be personally. That's not the goal. But the goal is to become more innovative in things where we should have a comparative advantage. And I already mentioned them: green, aging, and why not some supply chain aspects, obviously semiconductors being one. So that's all from my side. Thank you for your time.
Well, thank you so much, Ms. Garcia Herrero, for once again this honest view of the situation, but also proposing some solutions, or at least, and I like the fact that you're proposing collaboration and cooperation as one of the ways to go forward for all these global issues for all the economies. So thank you so much once again. And without further ado, Mr. Kit Juckes, I leave the floor to you for the last speech. And you can activate your mic. We can't hear you.
Shall I do that? That makes it easier for you, I guess.
Yeah.
Good. Hello, thank you for having me talking today. It's been fascinating. I kind of feel as if I'm dampening the tone, moving back to markets and away from the big issues confronting the world. But I guess that's the way we go. I'm just going to talk very broadly about some of the big issues, but I'll put all the forecasts at on the slides at the end so that you can pick them apart and throw rocks at them if you want. But if we move to the first slide, then I just have a couple of questions that I would ask. Where we are now, and you've had a good description of where the global economy stands. The first question for markets is when will the US Federal Reserve start to raise interest rates, and how far will they go? I think how far will they go is more important, but I'll get back to that. Will the European reopening drag bond yields higher? And you heard a lot about the European reopening just now. The one thing we've learned from the pandemic is, to me, it's not where you are relative to each other in a matter of 1 or 2 months that matters. It's where we all end up, which is hopefully in the same place. But right now, Europe is in catch-up mode, and that's very important for markets. Can Japan keep the yen cheap when the rest of the world has discovered Abenomics? I think this is very important for the yen. It's a cheap currency in my world at this point in time for more than one reason. But there are questions that we have to ask about that. And will the Fed undermine the dollar? It's a consensual view that the dollar will be weak, although the market's quite split. Can you have the world's strongest economy and one of the world's weakest currencies in the short term? I think the answer is yes. And finally, what happens to the euro, to at least the currency we have in Europe, I think depends much more on what happens in Europe. But I'll start at least with one chart of US interest rates and 10-year bond yields since 1984. I started work in 1984 in Frankfurt. And in 1985, a Japanese bank called Mitsui Bank then brought me back to London to be an economist in their treasury department. And that's where bond yields were when I started. They have gone down and down and down and down. And each cycle, with almost no exceptions, the peak level of US interest rates is lower than the previous one, and the debt level is higher than the previous one. We increase our demand when interest rates fall. We borrow money. In many cases, in the UK particularly, interest rates fall. We borrow money, we buy houses. And then when we get in trouble, interest rates fall again, so we can borrow more money to buy more highly priced houses. And we've been doing this for all of my life, it seems. So when it comes to answering the first question, where is the US Federal Reserve going? I think a lot of the answer is my first best guess for where US policy rates will be in 2, 3, 4 years' time when they start to when they have raised rates, will be back to the same peak as in the last cycle, but probably not higher, because the one thing I know about this cycle is we've layered on more debt. And so the level of interest rates, which hurts the equity market, which hurts the economy, keeps on going down. And even in a cycle where we're unleashing some short-term inflation pressures, I don't think that's changed that fundamental story to any great degree. So the Federal Reserve will be slow to raise rates, they've told us. They may not be quite as slow as they're saying, because they may be alarmed by the inflation trends, but they'll probably not get rates much above 2.5% at the next peak. And the peak level of bond yields probably won't be much higher than that either at any point. And I think that's what history screams out. When we contemplate these sort of charts for over a long period of time, maybe the one thing that I would be optimistic about is that we can get away from this slow grind down towards global deflation and break this channel of rising debt, falling interest rates, and slow growth, and actually turn my long-term chart higher. Maybe my children will enjoy some higher bond yields to save for their pensions, but I'm not too optimistic about the next few years. If we slide to the next chart, it's a chart more to look a little bit about some of the currency stories. Firstly, for the yen, and I think the yen is important. If you look at the top right picture on here, I've shown the value of the yen relative to real long-term rates, and I've shown the yen as a percentage over or undervalued against the US dollar just on purchasing power parity. So just on a measure that shows what you can buy in a shop in the two countries. The yen has been, for most of my career, an extremely overvalued currency. That was the net result of the 1980s, when the Japan became a country with a large holder of foreign assets, and it made it difficult to get the currency cheap. And as the currency in real term got more and more expensive because of deflation in Japan. And that has finally been defeated, and impressively so in the last few years. And you can see that piece 2016 to 2021 has achieved that. The question is, can you continue to maintain that when the rest of the world has Abenomics policies as well, very similar ones? And it gets harder. And the only way I thought I could at least demonstrate quite how cheap it is. So the picture at the bottom left is from a film called Lost in Translation, which was filmed in Japan about an American film star who went off to film an advert in Tokyo. But it's filmed in the Hyatt in Tokyo. And if you run an index to work out where the cheapest places are in the world to buy things, you can do a Starbucks index, a Big Mac index. So I have a Grand Hyatt Martini index. And the cheapest place I can buy a Grand Hyatt Martini is in Tokyo, or it was last time I was allowed to get on an aeroplane and go to Tokyo and buy myself a martini, since I haven't been able to go and buy one anywhere for the last year. And that's the victory of Japan. And the important piece is the price of the martini didn't really go down. The price of the yen has adjusted and made the martini cheap. The most expensive martini, by the way, is in Paris, in the middle of Paris, in the Place Vendôme, in the Hyatt there, which just says to say something, narrowly beats the Hyatt opposite the Swiss National Bank in Switzerland. But that's the challenge for the yen. I think it will remain an expensive currency. I will say just really briefly, the biggest driver of the yen now, though, may not be the dollar-yen rate. It may be the yen-yuan rate. That harks back to something you heard just before, but this makes the yen trade in narrower ranges because the biggest economic partner for Japan is China, not the United States or Europe, and the Chinese don't let their currency float freely, and that's very important. For the others, when I look at the euro-dollar rate, the euro-dollar rate was dragged down by Draghinomics, by Mario Draghi's policies of negative interest rates, and very successfully so in 2015, just as dollar-yen was dragged up by Abenomics. The current Fed policy makes it almost impossible to go back to the levels that we saw in terms of the extremes of weakness that Abe achieved or Draghi achieved. I don't think it's possible. In the short term in Europe, it's definitely not possible because the European economy, as you heard, is recovering now relative to the United States. And I think that makes a huge difference. So I suspect that what we'll see is a stronger euro. I suspect we will continue to see a stronger euro against the Japanese yen for a while, but the bottom right chart shows the Europeans are going to struggle to make that continue to happen. But the real key is if the US can't escape this pattern of lower peaks or not higher peaks in interest rates in cycle after cycle, then I think they will not be able to continue to have the super strong dollar that they've had for the last few years, which is a product of, more than anything else, Abenomics, Draghinomics by the ECB and other people getting interest rates to zero before them. And I think that's very hard to achieve. And the final slide shows all the forecasts for some of these yields. That's so that you can tell me I'm wrong at any point you like in terms of where we go. Clearly, I say we have an answer that we come out with on in terms of when interest rates start to go up in the United States. We're not terribly different from the rest of the world and where yields go. But if we look at that longer term picture, I think if the challenge in Japan is escaping the lack of investment, the challenge in the world is escaping this addiction to more and more and more debt, which is incompatible with less and less and less inflation in recent years. That's everything I will say, at least at this starting piece, but I'll certainly answer any questions anybody has in due course. And thank you very much for listening.
Well, thank you, Mr. Juckes. I think you managed to make everyone wants this webinar to end and go prepare themselves a martini if they can do so. I guess it's easier for us here on this part of the world in Asia than back in Europe, even though that's debatable. But but thank you so much for your intervention, and I guess I'll jump right into the questions and answers. And we have one question from the audience, exactly on some of the things that you've talked about, more on the recent history, and it's about the Japanese yen value against the euro, which has been dropping sharply in the last couple of weeks. Do you have, it might be hard to comment maybe on those, but how do you explain it, and what evolution do you foresee? So you've explained some of the evolution, but maybe commenting on the decrease that has happened in the past couple of weeks, if you have any insights on this?
I think, I mean, the yen has been the most sensitive currency in the world by far to the level of global bond yields, particularly US Treasury yields. So as US government bond yields have risen, the yen has weakened. Whereas the euro, for the sake of argument, has been strengthening as the European growth stories improved and as European bond yields have moved higher. So the driver, if you will, of euro yen has been the optimism that you heard expressed from Alicia about the European economic recovery and the benefit of finally catching up on vaccination. While in Japan, the JGB market has remained as dull as usual, which I'm not saying is always a bad thing, but it's locked yields down. So what's happened in large sense is that Europeans have made it not quite possible, but in terms of Italian debt, for example, or Spanish debt, for a Japanese investor to move money into European bonds. And that's a slight shift from what happened last year, when the most appealing thing was to buy US government bonds for a Japanese investor unhedged, and European bonds hedged. As the US yield curve has steepened up, the appeal for an investor to buy US government debt is only to do so hedged back into yen, and buying European debt actually becomes more interesting in some ways. So there are shifts like that, but the yen is a real conundrum this year. It's weakened somewhat within a range, simply because bond yields globally have gone up, and the surprise bond yield rise has been how much European yields have gone up, even if they're still negative.
Okay, yeah, thank you for your comments. We have a number of questions, and please, from the audience, keep writing them in the Q&A section. If we don't have time to cover them all, we'll try to distribute them to the speakers who have some sort of insight. Ms. Garcia Herrero, there is a question asked more directly to you, but I guess it could be also directed to others. But you did talk about the US recovery. You said that it has been mainly supported by the recovery of consumption. Can the same be expected from or in the EU and in Japan? And the comment is also that many EU countries have an aging population, just as Japan's population, even though Japan is more extreme. But does this prevent some of these EU countries and Japan from having a quick recovery?
Well, I'll be very brief. I think the US is particularly akin to recoveries on consumption. I mean, this is an economy with structural current account deficits and structural lack of investment. So in a way, it's just a natural feature of US recoveries. I don't think this is the case for Japan and Europe generally, where savings tend to actually be larger than investment. That's this kind of excess saving type environment. And therefore, I think the recovery of consumption will be less strong generally. Also, let's bear in mind that the fiscal stimuli, I mean, in this first part of the pandemic, yes, they have supported wages and, of course, SMEs, etc. But in the second round, next generation type, basically EU-level stimulus, it's about investment. You know, a lot is going to be invested. So I don't expect consumption to be so strong. There's, of course, pent-up demand, yeah, because we are out of lockdown. But I don't think it's going to be so structural. And I also think that consumption behavior is changing. There was an article in the FT this morning which surprised me about reopening of pubs and restaurants. And the figure, I mean, it was staggering, really. 27% below COVID, below pre-COVID levels, even now. That so, and I don't think it's going to be very different anywhere else, because people have changed habits. And I'm sorry to be so negative for those in the consumption sector, but again, innovation can help probably think of different ways to consume.
Yeah, thank you for this insight, and that actually bridges quite well with the first questions that was asked based on that recovery. But basically, you, Ms. Garcia, but also Mr. Kono, you both mentioned that the massive stimuli plans are certainly the main source of growth, or they were the ones that were able to help the recovery. But also, some research demonstrate that global productivity has improved massively during the past months, thanks to work from home, global intervention. If this is confirmed, do you have any views on long-term implications of labor productivity on this growth momentum? And maybe Mr. Kono, you can start commenting on this.
Oh, okay, productivity. You mean that Japan's productivity?
I guess the comment was more global, but I think, I don't know if the research showed that the productivity was mainly in Japan, but yeah, probably you can comment on this.
Okay. At this moment, my small concern in the kind of zombie companies or the zombification. You know that everyone explained that you know, in most countries, you know, with the aggressive fiscal policy and monetary policy, you know, many companies were supported, and thanks to this, the number of you know, number of the bankruptcy over the world is declining compared to economic expansion time. That means in some company that should exit, remain, you know, continue to do business. So, say after the COVID crisis is resolved, you know, we might see the increase the number of bankruptcy over the world. But actually, this is not a big problem because, you know, some company, you know, that should exit still remain in the business. But maybe under the democratic countries, you know, to prevent the increased bankruptcy, you know, we try to support them. That means, you know, decline in the productivity. So of course, you know, most company might revive thanks to the pent-up demand appear. And so it's not a big problem. But for the many countries, policymakers, important point is, you know, if the time comes, they should withdraw the aggressive fiscal policy, I think. It's my comment on the productivity growth.
Great, thank you so much, Mr. Kono. I maybe would like to ask a question, maybe a broad question to all of you, the three of you, together your view. Armel Cahierre earlier, the president of the Chamber of Commerce, commented that we will have at the end of the year a business summit focusing on visions for 2050, which is a very ambitious topic to address, given the fact that it seems that it's already really hard this year to get a vision 3 months from now, and we're trying to get a vision 30 years from now. But I think you have all commented on some of the things that have happened in the short term and the implications that they might have in the long term. More specifically, Ms. Garcia, you said this is 2021 is one of these years, but it's also because it will be remembered as a very specific year. But maybe I'm looking for some of your comments of 30 years from now. What will we think back of what we're living today in a financial and economic way? And what do you think we're also giving to the future generation with all the debt that we're raising and so on? So kind of some of the views and some of the points that you think we should be addressing in the summit that we will have in November. Anyone wants to start and jump in?
I'll kick off with a couple, if you like, just for the first one. If I think about it in terms of the next 30 years, and if I think back over the last 30 years and the things that have changed, there are a couple of things that I think will change completely. One is that the pandemic has taught us to work in a different way. We're never going to go back to all working in gleaming hours for 12 hours a day in the way that we did before. Globally, we'll have a different balance of how we operate things that will probably make megacities less important and people living in more semi-urban environments in lots of the West in particular more important. And I think that's going to be a change that we'll feel on a day-to-day basis. And I don't know if it's really productivity, but it means we're more efficient. I can be much more efficient from several places than I used to be. The second one is that we are going to, and we're not today going to, but on a 30-year view, we're almost certainly going to have turned the inflation cycle round for the first time. Over the last 30 years, so from when I was, from when I was just about to be 30 years old, we started to see this massive disinflation from globalization and from technology take over the world, so that you could send a computer disk even back then to a factory somewhere else in the world, and you could make goods and send them back to Europe just by sending a disk and having a phone call. Now, obviously, you don't even need the disk to be able to do this. This has driven globalization, and it's driven the way that the world works, with this massive increase in global supply of goods. I suspect that we're getting too excited in the short term about what's happening to disrupt all of this. But in a 30-year horizon, we are no longer going to be awash with an excess of cheap stuff that we want in the same way as we are now. Partly because more and more people in the developed world will have more stuff than they want. We all bought too much stuff during the pandemic. And the other side of that, though, is that we're going to be paying more for services, more for the services that we appreciate. The big leaps forwards in medicine that we've seen, things like that. That's the place where we can get. But I think that's the one chart I would like to see 30 years out. My bond yield chart is going to be higher in 30 years than it was 30 years ago. It's going to turn itself around.
Thank you so much. Very interesting. Anybody else, Mr. Kono?
Yes. Yep. This time, all people realize that two things. One is that innovation is very, very important, but dark side of innovation is the income inequalities. So, how do we cope with this innovation? Try to decrease the income inequalities. if we see the human being society, history, under the big income inequalities, democracy doesn't work well. It's a history from the ancient Greek period. So key point is whether can we manage the income equality and innovation, I think. And this time, Biden administration seems to change the big trend of the a kind of small government, which began in the early 1980s, led by the Reagan administration. And some US people saw that Biden is another FDR. But you know that why Franklin Roosevelt succeed in the big government is it is the era of the big war time. So key point is whether we change the society trend or not, I think.
Yeah, thank you so much. And Ms. Garcia Herrero, we have a few minutes left. You already touched upon some of the points at the end of your presentation. I think it was very interesting, but maybe you want to expand or comment?
Yes, very quickly. Those points were really for 2021. I don't think we Europeans, Japanese should wait until for 30 years to do that. In 30 years, though, the relative size of Europe and Japan will be so much smaller. And I think we need to acknowledge that and what that means. So I guess we have two scenarios. One is we're small but beautiful. And by beautiful, I mean that we are very developed societies where, the rule of law holds with a very efficient government. And we've managed to reduce, perhaps thanks to increasing productivity, why not, the debt burden on our shoulders, no matter our smaller and probably aging society still then. We, of course, in 30 years, we could have even changed that, by the way, but that's one. The other one is that we actually, and this is negative, and I hope we can fight it back somehow, that we remain at the edge of, or maybe we're even swollen by a different model, which is state-driven, big state. Maybe I like the idea of zombification, but it could be zombification or simply, large state companies running the show, unproductive, but still, manageable because of our relatively high income per capita, because the population keeps on shrinking. And therefore, basically, we remain at the border of a model we've bought into. And I don't mean to say it's China, because I know that seems, it could simply be a consequence of COVID. We can't cope, thus the government takes over, yeah? And it could be both. It could be China's influence, but it could be our own inability to be more productive, to be more innovative, to keep what is best in our model. So these two things can happen by, in 30 years, and I hope we take the right route, and I will leave it here.
Yeah, and we all understood which of these routes is the most preferable one. Thank you so much for your comments. I had quite a number of topics that I still wanted to address, but we'll need to do a follow-up session because we're running out of time. But thank you so much to our three speakers today. This was very insightful. We were really happy to kick things off with you this year, and we hope to see you also at the end of the year for the Business Summit. And thank you all to all the people who could attend. I wish you a good rest of the day, and I hope to see you for our next events. Thank you so much. Bye-bye.
Thank you.
Bye-bye. Thank you. See you next time.